Hi everyone, this material, the G equal RIR times ROIC. We talked about how to analyze forecast about growth. We talked about assumptions in steady states, and we talked about taxes. As we went over that, we talked about the steady state, and I was asked to add the equations here on the right side and the left side, which I did. So if you notice, I added all the equations on the right side and on the left side, so it will be easier for you guys to follow how to use these, a direct method and enterprise method, which we sometimes call indirect. So this is right here. Hopefully it will be useful for you. And what we're gonna do today, we're gonna go into cost of capital. That's the next part. So one more time. If you remember in our simple example, we had this kind of a naive, I called it naive, or a small, very simple example. We have the growth period, we have a steady state, which we quantify in Gordon equation, we do a discounted cash flow, and we get the net present value. Okay, we talked about how to estimate the growth in the short term and the steady state last session. And today we're going to start talking about the cost of capital. How do we use, I mean, we used here cost of capital, the WACC, but how do I calculate it in real life? Okay, so the objective is starting today and next sessions is to how do I estimate WACC? But before we do that, we want to see how important is the WACC in the valuation. So I built up, in fact, I didn't really build up, it's a question I gave in previous exams. If you go to cost of capital, introduction, you have questions from previous year's exam. Really, I like this question because it highlights many elements we talked about so far, and it's a good bridge to the next topic, focusing on what WACC is, okay? So what I'm gonna do is I'm gonna read the question. This is it. This is what the WACC is, and this is the example. Let me make it bigger a little bit so you can see it better. I will read it, and then we will go and analyze this question and how do we solve it. That will be a good way to summarize the material so far. And then we will see why it's so important the next few sessions to dive into the component of WACC and taking a lot of things that you thought that you know, but you really kind of slipped in your previous classes. So let's read the example. You have a great idea to open a playground in Tel Aviv. Just made it up, yeah? Okay, you need 250,000 initial investment. That means this is the amount of money you're going to raise. What I did here in the solution, I organized all the parameters we're going to read in a second right here. So don't worry about it. All the detail will be right down here, okay? So that's the initial investments I need. And then you decided that you're going to finance it in two ways. It's to raise debt and raise equity. And how much debt you're going to raise and how much equity you're going to raise in a proportion of 5 to 4. Meaning, on every $5 of debt, you're going to raise $4 in equity. Before even I continue to read the questions, let me open an Excel I prepared for you. In fact, it's already on the website. It's right down here. Just to clarify, what does it really mean that you're raising 5 to 4? So if you look at this Excel, what does it really mean raising 5 to 4? That means debt, if I'm raising $5 of debt, I'm raising equity $4. That means that for the company, I raised $9. Okay, what is the proportion of debt to the total amount in the company? That will be 5/9. If I'm raising 4 out of 9, that will be the proportions of how much equity I'm raising. So in this example, we're assuming that I'm raising 5/9 as percentage of the total of money I need for the company in a way of debt, and I'm raising 44% in equity relative to the total I'm raising. So if I'm raising 9, 5 of which will be in debt, 4 in which will be in equity, that means 55% or almost 56% in debt and 44% in equity. Okay, that's the meaning. That's the meaning in the questions here when we say that the company have raised 5 to 4 proportion of debt to equity. Okay, so for every $5 of debt, we're raising $4 of equity. In addition, we are given that the company is paying 6% interest on the debt, and the WACC is given to be 12%. Please pay attention that you are not given what is the expected return of the equity owners. Okay, let me pause here even before I continue the question. Okay, don't worry about it. We're going to discuss this question in depth. So me stopping, I have a reason why I'm stopping, just to emphasize very important elements when you read a question like that. What I really mean that I'm raising in debt 6% and I have the WACC 12%. Can I know from that what is the return on equity? Okay, so I need to go into the equations of the WACC. We all know that this is the equation of the WACC. The WACC is a weighted average. Those are the weight. By the way, this one we already know. Let me write it down here. Let me skip all of that. I'll get back to that. The market value of debt to value, this is 5/9 we are given. And you already know, I will add the remaining later on. I'm just emphasizing what is in the parentheses, okay? And that's the share of the equity. That was 4/9. Okay, am I giving the RD? The RD is the interest. So let's see, the interest we already read, it was 6%. Okay, it's given here, it's 6%. So I can really plug it into the equation. So here I have 6% times 5/9. Why? What happened to the taxes? I should really add the taxes. So if you keep reading now, you will see that one of the assumptions is that we assume that the playground going to be forever and the cash flow will be constant and there is no growth and there is no taxes. This is really just to simplify the equation, the problem. So one more time, we're assuming no growth and no taxes. So in that case, going back to the equation, so taxes is 0, so I can really ignore the whole thing here. And only things left, it's just plugging here is RE. RE times this one. Okay, am I given the WACC? Yeah, they gave me the WACC. The WACC is 12%. So if I put the WACC here as 12%, can I find out the cost of equity? Anybody?
Yes.
Definitely, I can just shuffle around the equation, right? And that's really what I did here before the session. The only things I did is really I took the whole left side. You see this, the whole left side, I moved it to the whole right side, this part of the right side, I moved it to the left side. So I have WACC minus the whole things here. So that's really,
Amos,
yeah.
isn't the market value of equity though kind of variable?
Hold a second, we'll get there. We'll get there. Don't worry about it. You're hitting on a very important point. In fact, this is one of the most important points of this exercise. So hold on. You are on a very good point, okay? We'll get to that in a minute. You're absolutely right, okay? So if I'm moving this part to the left side, so I'm doing WACC minus whatever I have here, then I'm left with RE times that one. So I just really have to move this one to the left side. That's exactly what I'm doing here by dividing by this amount. So I'm isolating the RE. Whoever likes to write RE on the left side, that's fine too, okay? So that's exactly what we're having on the equation here. RE, it's equal to the WACC minus what is really the effect of the interest. Then I'm just dividing by the share of the equity. That's giving me the RE, okay? Here I just simplify it because the taxes are zero, there's no taxes, so it is a WACC minus RD times that and divide. I have all the numbers on the right side, therefore I can find the RE. So let's see if I want to calculate it. How would I calculate it? Let's see if I think I did this already on the Excel. Let's look it up. Let's see if I have the calculation of the RE. If not, we will do it in a second. Where's the WACC? Here we go. We have WACC 12%, okay? And I want to calculate the RE.
Just above dividend at the last row.
The last, yeah, here we go. Okay, how did I calculate that one? So let's go step by step. I take the WACC, which is H4. H4, it is the WACC, the 12%. I subtract from it the RD, that's the 6%, times the share of the debt. How much is the share of the debt? It's right here. This is 5/9. This is 5/9. I put the 5, the 4, I got the 9, 5/4, give me this one, and that's the amount that I'm plugging here in the equation right down here. So I subtract that one according to the equation, divide by 44%, I get the RE. So the RE, it's simple. There's nothing special. You should really know it from your courses in finance, okay? And we'll come back and I will remind you again as we follow along, okay? So this is just really, when you read a question like that, don't get confused, just try to understand the meaning of the question. If I was in the exam, that's what I would do. Immediately my mind, just to organize my mind, and now I will read it again. I need to invest 250 in a business. I need to raise money. I'm gonna raise it in proportion 5/4. I'm giving the interest rate and I'm giving the WACC. Giving the interest rate, giving the WACC, and I'm giving that there is no taxes, I can calculate the RE. Now that I understand the question. Now let's see what I'm asked to do. And the first thing that I was asked to do is calculate earning before interest and taxes, meaning operating income before taxes and interest. How do we do that? That we learned last session. So let's go down and see. It's really nothing but taking the 250, multiplying it by ROIC. By the way, I think it's supposed, how much was the ROIC here? 14%. Okay, good. So 14% times 250 give me 350. I organize it in Excel as well. So if somebody feel more comfortable in the Excel to know how we get everything, so although you have the equations here, basically I'm taking the 250, that's the assets, multiplied by ROIC, I get 35,000. What does that mean? That means this company is going to generate 35,000 from now to infinity, just for simplicity for now. Later on, we're definitely going to change that. That means they're going to generate 35,000 every year. Why? Because we're saying there's no taxes, there's no growth. Therefore, the 35,000 is not going to grow over time. It's going to stay all the time, 35,000. Now the question is, how much those 35,000 worth? If I know that the WACC is 12% and there is no growth using Gordon equation. Anybody wants to help? One more time. There is a business generating 35,000 every year from now to infinity. And the cost of capital, the weighted average, is 12%. Just let's see who can help us out. What is the market value of a business like that? Anybody?
Could you repeat the question again, please?
Yeah, you have a business generating 35,000 every year. A reminder, let me open another folder here. So we don't leave that page. I will just go to what we did last week. Here we go, we have the Gordon equation. What's the value of the company? We know there is no growth, so that's zero. We don't really care. There is no taxes, so what do we have in the numerator? Only the EBIT, is that right? Everybody agree? No taxes, no growth. So yes. The numerator is really just the EBIT. Everybody happy? So yeah. To find the value of the enterprise, I take the EBIT divided by WACC minus G. There's no growth, that's 0 too. So it's EBIT divided by the WACC. So let's go back to what we just did. So how do I find the value of the company? It's really taking the EBIT divided by the WACC. That's exactly what we got in that equation. There's no taxes, no growth. Therefore, it's EBIT divided by the WACC. Okay? That's the value of the company that we're just dealing now. I just did the calculation for you here in the Excel. Whoever feel comfortable. How do I get that number? Very simple. 35,000, let me do it again. 35,000 divided by the WACC. The reason is, the truth of the matter, I should really do divide by WACC minus G, but G is 0, it doesn't make any difference. Fair enough? So this number is exactly what I'm getting here. EBIT divided by the WACC, I get the value of the enterprise. Now, why is it a very important first stage? Although you were asked to calculate it, I made those in order to help you out in the exam event, to help you out to follow up and don't get lost. Why it was a very important step? Because I already know if the value of the company is 291 and I'm only raising 250, am I generating value? Anybody can help. By creating this business, did I create a value?
Yes.
Definitely. How much did I create value? How much value did I create?
$40,000.
Correct. Absolutely right. Beautiful. So if I look at this one, minus the amount that I raised, that's exactly the value creation will be $41.6 thousand. So that's beautiful business that I'm going on if my assumptions are correct. And if I'm going to live up to my assumptions, then I created value. Now my next question is, how much money I'm going to raise as debt and how much money I'm going to raise as equity. Remember, I'm going to raise 250,000. If I'm going to raise 250,000, we said that we're going to raise 5 to 4. And many students immediately will jump and say, well, if the ratio is 5 to 4, okay, I supposed to raise, that's what you might do, it's incorrect, and in minutes we'll see why it's incorrect, you will think, okay, very simple. I will take how much debt I'm going to raise. I'm going to take the percentage of debt times debt to 150. And I claim this is wrong. Okay? I claim this is wrong. And then you say some things about the equity. You take the 44%, multiply by 250, together, it would, what happened? Should be plus. I think I screwed up here. Let me just. Okay. Equal to that amount times 250. And I claim that's wrong. Anybody has an idea why this one is wrong? By the way, you see those numbers here are different than they come out here. So anybody has a suggestions? That's why
there's a difference between book value and market value.
Exactly, it has to do with book value and market value. Absolutely right. And if you notice, I started by showing in the work example, I'm supposed to use here market value and not book value. And that was a hint to on what's coming up. So I'm going to raise 250, but this company really worth 291. Therefore, the equity owner, okay, they're going to invest in this company. I'm not going to give them my share of the value creation. They're going to pay whatever for whatever they're getting. So if they want 5/9 of this amount, they're going to pay 5/9 of this amount and not of whatever I need to raise. So I'm going to raise, the calculation should be that instead of that, I'm going to say, okay, you guys going to have 56% of this company, but I'm not going to multiply it by the book value. I'm going to multiply it by the market value, because you're getting a value of 162, you should pay 162. So the debt holders going to pay 162,000 to get 5/9 percentage of the company. Okay, so if they're going to pay 162, how much is the equity owners going to pay? Anybody? One more time, since the owner of the debt going to get 5/9 of the market value of the company, they're going to pay 162,000. So how much money more I need to raise and as a way of equity?
All the rest, it's almost 13,000.
So it will be 250 minus whatever I raised as debt. Fair enough? And that's exactly the amount you see here.
Why do we use the 250 and not the new value as well?
Here, think about it. You had a great idea. You generated, I mean, you know you're going to generate value of 41,666. You're not going to give it away, do you? You know, you are the entrepreneur. So you're not going to really give it up. So you say, okay, I'm building a company that's worth 291. I'm going to the bank and ask the bank, I want a loan of 56% of the value of this company. I show them my valuation. They agree with me. They believe me. I made them to believe me. And they said, okay, no problem. We'll give you a loan. How much a loan they're going to give me? They're going to give me a loan of 162,037. Okay, beautiful. They give me exactly what they're getting. They're getting really 56% of a company that's worth 291. Now that I raised 162, in order to start my business, I need 250. So I go to my bank, another bank, my own account, withdraw from there 87,000 and put it in the company. So 250, that's what I need. That's what I take from the bank, and that's what I put from my own pocket. Now I would like to ask you a question. What's your name, by the way?
Me, Noam.
No. Here, think about it. How much money you put out of your pocket? Almost 88,000. Is that right?
Yeah.
How much is really the value of your equity? It's a hard question, so don't feel bad if you don't know the answer, okay? Whatever your answer will be fine. Just
It's
give it
worth
a
what?
try. Think about it. You're building up a company. You need 250. You went to the bank. It gave you 162. Then you said, okay, I'm putting out of my pocket about 88,000. By creating this company, this playground, okay, I'm generated a business that has 291. I really created extra 81,000 as a value. To whom does it belong? To the debt holders or the equity owners?
Equity holders.
Exactly. So what do you see, Noam? Who does it belong to? To the equity, is that right? It's true that you put in the company 88,000, but really that 41 belongs to you. So the market value of your equity should be really 129. So if I came to you and say, no, please make me a favor, sell me your equity. You say, okay, I will sell you the equity in my playground, but I'm not gonna ask you for 87 or 88 that I put. Those equity worth much more. They're worth 129,000 or around almost 130. And why? You said simply because, you know, the value of the company is 129. We owe the bank 162. And therefore, the value of whatever remaining, which is the equity, must be 129. Or in another word, we can calculate, okay? We can calculate the 129. Let me erase those ones. We can calculate the 129 in a second way. We can go into what's the value of the company? 291. How much do we owe the bank? 162. The difference, it's exactly the value of the equity. Or in another word, is the same thing, says whatever the equity owners put plus the extra profit they made, that belongs to them. No surprise, you get exactly the same one. One third method, anybody wants to guess another method? We should get exactly the same number. It's just another manipulation. It's very simple. How about if I take the value of the company? What is the share of the equity in that company? Anybody?
4 out of 9.
44%. Beautiful. So how about if I will multiply it by the 44? Should I get the same number before I hit? Yes or no?
Yes.
Yes. Beautiful. So 3 ways we can really look at it. First one, it's simply whatever I invested plus the extra value I created, that give me the value of the equity. Another way is, I can take it's the same things really. I take the value of the equity and I will subtract whatever I owe the bank that belongs to me. And the third one is just simply, if the company worth that much, 56% belongs to the bank, 44% belongs to me. Therefore, 44 of this amount gives me 129. All those 3 confirms that we're probably right in the way we calculate it. Okay? Any questions, guys?
Amos, I don't have a question, but I just want to ask if you can please write next to the cells where you do the calculations what it is, so we can look.
That's what I did here. That's why I wrote everything's here. I just redo it manually. If you notice, I wrote everything's right here. The EBIT is 35,000. It's assets times ROIC. Okay? I just say, you know, I thought that the brain needs to see it several ways. So, and after you see it in the Excel, you come back to here, it becomes to be simple. I did
Perfect.
EBIT over
Thank you.
WACC. That's why I opened the Gordon equation, and I told you this is really zero, it's by assumption. This is zero by assumption. That's why I have only EBIT on the numerator. In the denominator, growth is zero, it becomes to be EBIT divided by WACC. Now you understand why in the simulation, we do have a EBIT divided by WACC. Now it's clear. And we demonstrated it in the Excel. Later on, we had debt. How much is the debt? It's the market value of the company times 5/9. D is 5 and V is 9. That's the ratio. That's the way we got the 162. The other way to do, and we did other three methods, maybe I will add the other three methods here, but either one of them is good enough. It's taking the value of the total company minus the total of the debt. I'm getting this one. So you have really all the equations right here. Okay?
Thank you. Yeah.
Welcome. Yeah. But it's really nice to see it in many ways. You know, first time it's a little confusing. It's also emphasizing on the market value. So that's why I did it two ways. Okay. Then let's go to the next point. The next point, they ask me how much, what will be the yearly interest payment? Now, what is the interest payment? It's the tax, the interest rate times the total debt. Do we know the total debt? Do we
Yes.
know the total? Yeah, we do. How much is it? 162, is that right?
Yes.
Therefore, in order to get the interest, I will redo it. I will take the total debt times the interest rate, which is the 6%. Enter, I get 9722. You have it right here, and you have the equations right here. I took the debt times the interest rate, I get 9722. This one is really nicely organized with all the equations, but we will do it manually so you'll feel comfortable, okay? Let's do the next. We already started with that, but let's calculate, okay, the 19.5, okay? Let's calculate that one. That one we use the WACC. How do we use the WACC? Remind you, I redid it also, the equation that we have right here, okay? I redid in the beginning of the session today. We started with the definition of the WACC. We shuffled it around, we moved this one to the left, and then we divided it by this one. We got RE equal to that one. So that's simple. I only have to plug the number. So let's do it, okay? Let's do it. So I'm going to the Excel, and let's do the whole things from scratch. Let's open parentheses. We have the WACC. WACC is 12% minus the RD times the percentage. How much is the RD? It's 6%, correct? Times the share of the debt. How much is the share of the debt? 56%. That's take care of the numerator, this part. All the whole things I'm going to divide by the share of the equity, by the share of the equity right here, by the share of the equity. So I'm going to divide it by 44.44. That should give me the return or the expected return on the equity using WACC. That's the way we started. Now we just calculated it. So if I look at it, how did I get to that number? Here we have the equation. The reason the equation shrunk because there is no taxes. So the RD is not multiplied by 1 minus D. We're just multiplying it by the share of the debt in the company. Okay? Questions? I went a little too fast, I think. So if you feel that way, please let me know before we move on. Questions, guys? Hello? Anybody home?
No questions. All good.
Is that clear? John? Josh? Just
Yeah,
with
all
us?
good.
Wow.
All good.
Good, good. I went a little fast, I felt. So I don't want to feel like I'm rushing and then this is very important, by the way, very, very important exercise. So don't be shy to stop me, okay? Okay, let's move on. You know what, let's do recap, 1/3. Okay, they tell me I need to invest 250 in the company. They gave me the WACC. They gave me the proportion of debt to equity. They gave me the interest rate. They tell me there is no taxes and there is no growth. And they gave me the return on invested capital. So stage number one, we calculated the EBIT. So how do I calculate the EBIT? We already know from last session. We took the assets times the ROIC. I calculated the EBIT. Then I asked myself, a company that generates 35,000 every year with no growth, how much does it worth? There is no taxes either. So it will be the EBIT divided by the WACC. Therefore, I get the value of the company, it's 291,667. Beautiful. That means I am going to invest 250 and I already generated a company that worth by 41,667 more. And that difference belongs to the equity, and in a minute we will see. Before that, we say, okay, how much money are we going to raise? Since we're going to keep as that part of the company going to be financed by debt, and that's going to be 5/9 percentage of the company. So I'm going to take 5/9 of that amount, and that's the amount I'm going to raise as debt. So I'm giving them exactly what they're paying for. I'm giving them 56% of a company that's worth 291,667. They would give me 162,000. I'm investing it in the company. Since I need 250, I'm putting out of my pocket 87,963 as investment as an equity owner, okay? Therefore, what is the market value of what I own? It must be that amount plus the extra value I created. And that gives me the value of the equity to 129,630. It is whatever I put plus the value created, 291 minus 250. Another way to calculate it, it's simply 44% times the value of the company. A third way to calculate it is the value of the company minus the amount of the debt. All three of them will give me exactly the same number. Okay, this is just two methods. You can add the third one if you want. Okay, beautiful. Then we said, okay, if I'm raising a debt of 162,000, how much interest I'm going to pay every year? I'm going to pay 9,722. How did I get to that number? It's the total of debt times the interest rate. You have the equation right here. How much is the debt? 162. The interest rate, it's 6%. Therefore, I have to pay every year 9,722. So far, so good? Anybody?
Yeah, we're good.
Good. I'm just repeating. I think it's worth repeating, by the way. You know, you can't really move on faster if you don't repeat and you feel comfortable. Okay. Last thing is we use the WACC equation to find the expected return on the equity. How did we do it? Very simple. We use the WACC equation. We notice that all the parameters are given. This one was given 12%. This was given as a 6%. There's no taxes. This one was given as 5/9. So we have all this data. Moreover, we have also this value, so we can plug it in. We have one equation, one unknown. We shuffle the numbers around. We get RE to be equal to the 19.5%. Then we ask, okay, anybody wants to guess before you can see it even, how much dividend can I distribute every year? Anybody? The company is making how much every year?
35,000.
Exactly right. The company is generating 35,000 every year. How much they're giving as an interest? How much they're paying as an interest?
9722.
Beautiful. So what we're going to do with the rest? What's the difference?
Going to figure out what the investors, what percentage the investors demand from the rest, and you're going to give them that.
Beautiful. So let's do it. How about we do it? Let's do it from scratch.
I have a bit of a question about that.
Yeah, hold a second, just 1 second. I want to continue with your line. You said how much the investor are going to ask for? What is the
Everything, because
percentage you calculate?
there is no growth.
19.5, is that right? They're going to ask for 19.5, is that right?
Yeah.
For multiplied by which amount? They're going to get 19.5 percentage of what amount?
The market value of it.
The market value of equity.
Beautiful. Don't mess it up in the exam. You are not going to multiply it by the book value. You're going to multiply it by the equity amount, the value, market value of the equity. How much is the market value of the equity? We calculated it before. It's right here in the bottom. 129, is that right? 630. And that's the amount of dividend. That's beautiful. Whoever answered that, that's beautiful. Anybody wants to tell me another way to do it? That's correct. By the way, that's a beautiful answer. You get all the point. You don't have to show another way. But if you know another way, it will be really nice.
So if you take the EBIT and you take out
beautiful. Let's do it.
the interest,
I like that.
Then
35,000.
But the reason is because you don't have any growth, right? So you are not reinvesting.
You're absolutely right. So I
So
take
it's zero
35,000
growth,
minus
zero
what? Minus what?
Minus the interest.
How much is it?
9722.
Beautiful. And we should get the same number, don't we? And we do. You know, it's a rounding numbers. Yeah, it's exactly the same number. Beautiful. So that means we're probably doing it right. Is that right? Makes sense. That's beautiful. I like that a lot. In a minute, we'll come back to the growth, by the way. You're hitting on a very important point, by the way. So we'll talk about it as well. Everybody happy?
Sorry, could you please repeat the second method to get that number?
Yeah. Say how much money you're making? 35,000. Let's go back to the original Excel. Okay? You have 35,000. That's the amount we're making as an EBIT. You see it? Let me make it a little bigger. Okay, you can see the 35,000?
Yes.
Okay. Now we're paying interest. How much interest we're paying?
9,722.
So the difference belongs to the equity owners. Is that right?
Correct.
That's why we're getting that 25,000. That's the second method. The first method, you say, okay, you know what I'm making? I promise the equity owners to get 19.5% as return on their investment. Their investment is really the market value of their investment. The market value of their investment, it's 129,000. So if I take 129,000 multiplied by 19.5%, I will get exactly the same number, and I'm supposed to get the same number. Otherwise, something is wrong in my method. So both ways gives me exactly the same number. It's 35,000 minus the interest. I will get how much I need to give them, or I can do the return they're expecting times the market value of their investment. Okay, 19.5 times their share in the market value of the company. Both method gives me exactly the same number, and they should, otherwise something is wrong. Okay, beautiful. By the way, if you notice, you have all the equations. I didn't really write here all the method, but at least you have the understanding of it. So we got to the dividend. Beautiful. What do you say? Is that a good business or is that a bad business?
Good.
It's very good. I'm creating value, 41,000. Now, if I ask, the last question here was about growth. Notice we assume that there is no growth. Would you recommend to the owner of this company to take the right actions to grow, and why? First of all, I should really have asked also, what are the right actions in order to grow? How will you grow in this company? You as an investor.
Increase ROIC.
Say again?
Increase your return on invested capital.
That's different issue. Hold on that, I'm coming back to it. But let's assume this is the ROIC. Can you create more value by doing something? Beside the ROIC, which you're absolutely right, but I will get back
Lowering
to
your WACC.
Say again, lowering the WACC.
Lowering your WACC.
Beautiful. Lowering the WACC, it's a third way. Let's keep those two. You're ahead of me by 2 points. You're absolutely right. But what another things? Say, just pay attention to the question that here I try to focus on growth. How do I increase growth? Not changing the ROIC, not changing the WACC. Both of them are beautiful answers. But now I want to focus on the growth. WACC is constant. I assume it's constant. ROIC for now is constant. How do I increase the value by growth? Can I do that? And how do I do it?
So you decrease the dividends?
Increase or decrease?
You decrease the dividends.
Beautiful. What happens if I decrease? That's reinvestment. Is that right?
Yeah.
And reinvestment will grow the company. That we learned from last session. So if I'm holding on part of the dividend instead of distributing it and increasing the assets, that means this company is going to grow. And if this company is going to grow, I should get a bigger value, because now who can complete the sentence? If growth is growing, meaning I have a higher growth rate, more than 0, let's say 3%, I hold some of the dividend and reinvest in the company is going to be more valuable. Why?
Because the ROIC is higher than the WACC.
Beautiful answer. That's a complete answer. Just complete your answer. ROIC after taxes is higher than the WACC.
Yes.
Okay? Here we don't have taxes, so your answer is complete. Okay? Beautiful. That's exactly right. By the way, I'm thinking about adding right here. I don't know, you recommend. I thought to add the G here, put it in a 0 originally according to the question, and then allow you to change it to a higher number and see that really the value of the company goes up. Okay? And that could be. What will you put it? Will you put it here, guys? What would be nicer for you? To put it here, or should I put it here?
Where you say first will be nice, where all the variables
here,
are.
right here, you like it here?
Yeah.
Anybody like it here?
Yes.
Who like it here? What's your name?
Top is better.
Sasha.
Sasha. So I tell you what to do. I asked the same question in the other class. So Sasha, that will be your role. Will be interesting. Ask your classmate and tell me what the majority of them just think where we should put it. Should we put it here or should we put it here, and you send me an email, okay? After I get your email, whatever you guys decide, I will put it. I think you have better instinct to decide than I, because for me, it doesn't make a difference, okay? Because I'm used to it. But
So
for
I
you,
send you an
you-
email or the representative? You want from me an email?
Yeah, one of you guys, doesn't
Okay.
matter, the class representative, anybody, just shoot me, just ask the class, and I will edit here. That will be a really nice exercise for you guys, so you can play with it before the exam, and you remember that point, that in this example, I should really have a higher growth, because higher growth will create a higher value, and you would like to play with it. So change the growth rate here, and you get a higher value. Now,
Hans, could you maybe just repeat that method again? Not the
Yeah.
ROIC, not the WACC, but the growth?
see the growth, since the ROIC after taxes is higher than the WACC, see the ROIC is 14%. The WACC is only 12%, okay? Since the ROIC is higher than the WACC, okay, I should, like what we studied last session, and there's no taxes in this example, okay? So 14, it's higher than 12. In that case, growth will increase the value of the company. That's what we played last time. Let's go and do it again. What the heck? You know, let's do it again. If you remember this example, you see this example?
Yeah, I
And
remember.
this one is really just golden equation, just using the number, the parameters, and calculate the V. So we started from a simple example. The assets was 500, ROIC 15%. You take this one times this one. Here we have also taxes. Let's just put a 0 here, just for the simplicity. Okay? So this one times this one, I got the EBIT. Fair enough? Since the WACC is lower than the ROIC, the value is higher than the assets. Let's put growth 0 as well. Okay? How much is the value of the enterprise? Is 1,000. How much is I invested? It's 500. Since I'm investing only 500, the value, I created value. Why there is a creation of value? Because ROIC is higher than the WACC. Let's play with it. Let's do another example. By the way, this is the nice thing about clicking here. If I take this one to be 10%, exactly like the WACC, pay attention, there is no creation of value. You see that? You see it?
Yes.
That's nice. This is why I made that kind of a mini simulator. Now, see, if I raise that one a little bit, 11%, that will generate value. Let's put it back, because I want to explore two cases. There's no creation of value. I'm going to add another one. What happened if I keep that one to 10 again? Okay, I keep that one to 10, and I have 500, 500. Is growth will make any difference to value? I claim not. Let's put 4%. Nothing, didn't change anything. The reason is because ROIC equal to the WACC. On the other hand, let's add another case. 500, let's put back here 11%. Let's put WACC 11%. We have 550. We have 550. Why we have 550? Because we have ROIC higher by 1%. That makes it that the value of the company is 550. Moreover, now if I have a growth, pay attention, growth from this situation to this one had no effect because ROIC equal to the WACC in both examples. So raising growth didn't make any effect. Now if I make another case, just like the one above, but with 11%, what happens if I grow? If I add another 2%, pay attention, it's raising it even further. So growth has effect. Let's put 3%, it's even more. Let's put 4%, it will be even more, 5%. 5%, it will be higher. So growth affecting value only when the ROIC is higher than the WACC. And this is a beautiful way to explore the effect of growth when this is equal to this and vice versa. You can play with it. It's a very interesting simulator. That's why I made it with several cases you can play with it. Okay.
Is there a limit? Is there a limit for the growth? I mean, if you put like, I don't know,
See, in the golden, very good.
15%,
You know,
then
this
it will be too much growth, no? It will lose value or something
no,
like
no.
that.
In fact, the equation doesn't work. I will demonstrate. Okay. Okay. That's exactly the same case as before. I changed that to 11. And people, please pay attention. If I put here 6%, it will still will be okay. I'll put 7%, it will be still okay. I'll put 8%, it still will be okay. I'll put 9%, it will be still okay. If I put 10%, what do you think gonna happen? See, it crashed. Why? Look at the denominator. If G equal to WAC, you're getting a 0 in the denominator. That's why we got infinity. Okay? So this equation works as long as the G is lower than the WAC. And think about it, it makes sense. You can't really grow faster than the WAC. In a steady state, we also will see ROIC has to be equal. We mentioned that last time. So even in real life, you can't really get a situation that G will be higher than the WAC. Here I kind of gave you a mathematical answer, but even in a common sense, in a steady state, usually ROIC will be equal to the WAC, because otherwise the company will go beyond anything. So it will be the only company in the world. So that cannot be. And the G cannot be growing more than ROIC, because then it's really like growing more than you really generating. So, but you can invest only what you generate, so you never can have a growth more than the ROIC.
So isn't that the effect of monopoly? I mean, if you are the only person that have that technology, then maybe you
know,
will
if
grow
you
that
are
way.
the monopoly, so the economy, that's the maximum, you are the economy. So you can go more than you are. I like the way you put it, by the way. So if I'm the whole economy, I can go more than myself. You know what I mean?
So you mean the growth will be the growth of the kind of your GDP of your economy?
Exactly. That's the assumption we usually do in the steady state. Okay. So I cannot really pass here the WAC. This is so 9% would be fine. And see, it's really, this is one of the problems of this equation. It becomes to be very like it's jumping. If you see 1500, if I take here 9, it'll go crazy to 5,000. If I do another 9, it's going to almost infinity. Another 9, so you're getting close to 10. I won't trust that equation, okay? So as long as it will be like, say, up to 8%, I will feel comfortable. Making it more than 8%, I will say this formula most likely going into the places that it's not really in a way that is going to be realistic in real life. Okay, so the lesson is growth rate cannot be more than the WAC. Okay, most likely something like that the most. In real life, you know, if you look at today, you most likely will see here growth rate around 2% and WAC most likely around 4% or 5%. That's really most of the companies real life today, by the way. ROIC of 11 is extremely high today, very few. If you really want to look at a company, a reasonable company, it will be between 5 to 6, so let's say 5.5. That will be more realistic, and that generating value, not out of the ordinary, but that's really more realistic of a lot of the companies today. They do exist because they do generate value, but not out of the ordinary. There are definitely companies like Amazon, Google, you know, Netflix, that you can see, let's say here, 10%, and they're generating a lot of value relative to the investment. And that's why they're growing a lot, okay? But I think this is a good review of what we did last time. Please play with it. This is really nice exercise. Let's go back to our question. I would like some of you that mentioned before, and I said they were very good point. Somebody mentioned that if you increase the ROIC, you create more value. Who was that, by the way? I like that comment.
That was me.
What's your name?
Sal.
What's your name?
Sa'al,
Sar, I like that. Remind me to give you 3 point bonus, okay? In the end of
Oh,
the
don't
semester.
you worry about that.
No, I'm not worried. Just to give you a bonus, why not? Okay? Send me, I usually like to give bonuses once in a while, just to encourage students. I like comment like that, okay? That's a beautiful comment. Let's see, Sar, what the meaning of higher ROIC? If you want to describe it in, you know, as a manager, you know, when I say, oh, if I increase the ROIC, then the value will be higher. That's the way we talk as a finance people. But you are as a manager, what do you mean by higher ROIC?
I would mean that I would invest more in my company. I would divert more of the funds I'm generating.
No, before that, when you say you have a higher ROIC, see, this is,
sorry, it would mean I'm more efficient in my
you are more
generation.
profitable, exactly right. So let's change this number here from 14 to 16. Pay attention, on the same amount of investment, you're getting 16%, that means you're making 40,000 a year now, much more than you did if you made only 14%. So saying increasing ROIC means that we becomes to be more profitable. We're selling more, we're reducing cost. That's what we call higher ROIC means better management. That's a reflection of better management, better operation, better saving on cost, better marketing, generating better revenue, higher revenue than I would do otherwise with 14%. That's really the meaning of it. That's a measure of performance, okay? So better performance, no question, will generate much more profit. Pay attention. If you look at it now, the equity owners originally had to invest even less. You see, because the value of the company is higher, I can get a bigger loan from the bank. So I'm investing only about 65,000 to get the 250. Moreover, even my market value is higher. So two things happening when ROIC going up. One is that I don't need to invest as much as I had to because I can take a bigger loan. Second, that the market value of my equity will go up higher. It will be 148. Fair enough?
Yes.
That makes sense, guys?
Can you repeat the first thing that happens?
Yeah. If you notice, let's go back to the previous example. 14%. The market value of the company, it's 291, higher than the investment. That means we're making about 41,000 extra money for this company. Immediately, we're creating value. That means if I go to the bank and I say, I need 56% of that as a loan, they will give me only 162. The rest, I need to come up for my own pocket. So 250 minus the 162 will give me how much equity I have to put in the company.
I have a question. Can
Let
you
me just finish
manipulate?
the answer for her, and then I will let you ask, okay? No problem, in a minute, okay? So what happened, but on the other hand, if the ROIC is 16%, the value of the company is higher. You notice? Now it's 333. If I have a bigger company, a company that has much more value, when I go to the bank and I'm asking 56% of a company that is more valuable, they're willing to give me a bigger loan. If they're giving me a bigger loan, then I don't have to put as much money out of my pocket. I'm putting less. You see that? Is that
Yes.
Noah?
Yes, I understand.
Does that make sense now?
Yes.
Beautiful. But see the beauty. The beauty, I'm already generating more value to the company. That belongs to me. Okay? The beautiful part of it is that really my market value of the equity went up than it was before. And the net is even higher. Now is really I'm making, the whole profit between 250 to 333 belongs to me. So my profit going from 64,000 or 65,000 to 148, that's really the extra value I created. The difference between those two numbers, it's exactly the difference between the 250 to the 333. And that's really nice to pay attention to. Somebody else wanted to ask a question before. Go ahead, please.
Is it possible to manipulate the ROIC? I don't remember exactly the formula, but I mean, by changing some variables there, maybe you can, I don't know.
Usually
we have to speak
I will
about
speak
the
to you.
dividends, let's say. If you decrease the dividend, you will probably increase the ROIC, right?
No, it will not. Don't mix it up. Remember last session, we spent the whole session on how do we measure ROIC based on previous years. ROIC, it's a measure of how much you're making cash, how much you're making profit, okay? Then when you talk about dividend, it's how do you use that profit, okay? So the ROIC didn't change when I distribute more or less dividend. It's if I distribute more dividend, that means I have less to invest, okay? And if I distribute very little dividend, that means I'm reinvesting a lot. And now what the link, you're right, there is a link, how much more value I create for the company, as long as the ROIC is higher than the WACC. If I distribute low dividend, the market value of the company will go higher even. But the ROIC haven't changed. Don't get confused.
So that's why there is a lot of companies that doesn't give dividends, so they want to increase their value.
You're absolutely right. As long as the company has ROIC higher than the WACC, they should really try to not distribute dividend, keep the dividend, and grow. A good example is Google. By the way, Google almost don't distribute any dividend. Another very good example, it's Microsoft. Microsoft, when they started and they realized they have a high ROIC, much beyond the WACC, they haven't distributed dividend for over 15 years. By the way, Google trying to imitate the same things. They just announced about 2 or 3 years ago that they're not going to distribute any dividend for about 15 years. So it's very interesting, and they're right. Because the investor would like it, because the investor rather to make a higher ROIC higher than the WACC, it means that the company is generating 16%, while the investor can get only about 12% somewhere else. So as long as the company is making more than I can get another place, I would rather to keep the money in this company and don't take the money out and invest it in an investment that gives only 12%. Does that make sense?
Yeah, thank you.
Beautiful. Somebody else mentioned that if you reduce the WACC, you can also create value. Who was that, by the way? Anybody? Somebody mentioned that, and I like that comment because it's a good one. So any other volunteer want to explain maybe why if I reduce the WACC? Let's try that first, okay? How about if I reduce the WACC to 10%? What is the value of the company now? And let's go back to the original example, 14%. We had 291. What happened if I reduce the WACC to 10%? Is the value went up? Oh, definitely yes. It went up to 350. Is that right?
Yes.
Why? Remember, how do we get that value? It's EBIT divided by the WACC. The EBIT didn't change because our investment was 250. ROIC didn't change. That gave me 35,000. But the value of the 35,000, getting it every year, it's more valuable because the investor are asking only 10% and I'm giving them 14%. I'm giving them now 4% extra. They're expecting to get only 10% out of the 250, meaning they're expecting only 25,000, but I'm generating 35,000. So by generating more than they're really expecting, That's creating value. So the lower will be the WACC. One more time, the lower that will be the WACC, the higher will be the value of the company. And now let's explore that a little bit. Who is enjoying that amount? Is the debt holders or the equity holders? Anybody wants to guess?
Again,
To
what's
whom
the
it
question?
belongs the extra jump in the value of the company? Does that belong to the debt holders or the equity holders?
Equity holders.
Exactly right. So if I were to tell you, you know, it's much easier to do 350,000 minus 250, it's 100,000. Is that right? This company generated extra 100,000 now. To whom it belongs, you said? To the equity owners. So what should be the difference between their investment in the company to the market value that they have in the company? How much is that should be equal to? So this number and this number. Can you tell?
100,000.
Exactly 100. It's supposed to be, because all the increase of the value must go to the equity owners. That's beautiful, isn't it? Do you like it?
Yes.
Okay. How about if you notice, by the way, if you notice when I change the WACC to 10%, if I keep the return on debt, which is the interest rate, you know, it's like the reason the WACC went down is because the investors are asking for a lower rate. How about if I play with it a little bit? How about if I change that one to 3% and I keep the WACC 10%? What does that mean? Anybody wants to help me? What does that mean? The interest rate went down, but the WACC stayed the same. What does that really mean?
That the return on equity changed?
Exactly. Why is changing? If the WACC stayed the same, part of the investor willing to accept less, and the average stayed the same, it must be that those guys be getting higher. They're expected higher. Is that right?
Yes.
So let's go back to our example, original one, 6%. And let's change everything back. Change back to that to 12%. So we're back to our original example. Fair enough? If I'm reducing, let's take a realistic scenario. If this company is very consistent and after 10 years, they always generated 35,000, investors think that this company is very stable, that means this company really has low risk. And we associate risk with return that investors expect to receive. So if I'm consistent company and I have I have a record proving that I'm really consistent and the investment in my company is very low, most likely I can raise money cheaper way. Raising a cheaper way, it means that I can take a loan from the bank probably for a lower rate, and instead of this is going up, this is really is going even down too. So if I change that one, let's say to 10% now, that's more realistic scenario. The average would go down. It's just because the simulation, the way I built it, you have 5%, 16.25. The weighted average of both of those one would give me 10%. That will increase value. How did I increase value? I reduced my weighted average cost of capital. How did I realize that? By convincing debt holders and equity holders to accept lower rate than they were asking before. How do I do that? Telling them that I really a low risk company. The lower is the risk, the lower will be the WACC. And how is that come to be real life? I can issue more bonds in a lower rate. The more I'm consistent, I might even reduce that to 4.5. Okay? This one can be confusing. I really should change that one to, let's say, 9%, that will do the calculation. So both of them now, the less risky I am, that means the WACC is lower, and that means that those two guys will be willing to accept a lower return on their investment. Does that make sense, guys?
So the RE also is gonna
Go down.
Go
Usually
down,
a
right.
company that is low risk, take a utility. You know, if you look at electrical company or like Hevrat Hashmal in Israel, or well, I don't want to talk about Enron in the 2000 scandal, but usually utilities, you know, they are really stable companies. They usually have big debt. They usually have low amount of equity, and the return on the debt on their bonds is usually low. And also the return that the shareholders expecting is also relatively low. Why? Because utility have stable customers, they have stable cash flow. They're not going to get their money. People always going to use electricity. People always will use water if it's a utility for water or whatever. Those are stable businesses. Those one will always will pay much lower rate than regular one. Who invests usually in utilities? You will see a financial institution like your pension plan or insurance companies that they want to make sure that their cash flow will be stable. They're usually a good candidate to invest in companies like that they are stable, they have a stable cash flow. On the other hand, if you look at the startups usually they are very risky. If they are very risky, usually they won't get a loan from a bank. So it's not surprising that when you start a startup, you're not going to go to the bank because they most likely won't give you any money. So what you usually do, you go to your father and he takes all the risk. So he will give you a loan, assuming kind of is an investor. That's usually for kids that you want to help your kids to do a startup because even, you know, even angels or any company that the financing startup, usually they won't even give you an equity if you're unknown at all. So you end up going to your father or to your mother or somebody or your relative that can give you a loan. When you prove yourself a little bit, you can go to an angel or some company that can give you a loan. They won't give you a loan. They usually will give you, and they will ask for a percentage in the company, meaning they're going to be an equity holders. And as you grow and you prove yourself, it will be easier for you to go to the bank and get a loan. And usually in a bank, you will get a lower rate than those angel or those companies that gives you an equity financing. That's why you're reducing your WACC as you go and you become to be more stable. So then one extreme, you see startups that are usually financed by equity. On the other hand, you have utilities that are usually financed by debt. And those are the two extreme ones. In the middle, you have all the other companies. So it's very common today if you see a mature company having 1-to-1, meaning debt to equity, the same ratio, that's very reasonable. And no surprise that you will see different industries might have different ratio on average between debt to equity, depends on the riskiness. The more risky the industry, the higher will be the return that the investor will ask, and the lower will be the debt to equity ratio. On the other hand, riskier companies, the riskiest companies will have a lower debt to equity. A less riskier one, the return that the investor will ask will be lower, and the ratio of D to E, meaning debt to equity, will be higher. That's really closing the circle. So if you look at the seasonal businesses, like playgrounds, like this example I gave here, who knows if there will be rainy days in the summer and then you don't know if you have customers. That might be a high risk, okay? And if it's entertainment, that it's closed area and you are independent of the weather, that would be lower risk. So let's say cinema city or something like that, that would be lower risk than, you know, Six Flags in the state, that you depend on the weather. So Six Flags is close to Chicago there, and Chicago you can get rain in the summer and then people won't come. So it's a little riskier than if you have a movie cinema or something like that, would be a little riskier. The Six Flags will be riskier, okay? It really depends on many factors that might affect the risk of the business, and the risk of the business will affect how you can really finance your business. So the reason I gave this example in this point of the course, it's summarizing a lot of the stuff we covered. This is a good summary, and this is opening of what we're going to do in the next few sessions. The next sessions is diving into the WAC component. But before I go there, any question, that's a good time to pause and answer your question if you have some. Anybody? Everybody happy? Sasha, happy?
Very happy.
Very good. So we can move on to the next topic, yeah? Okay, let's do that. Let's move to the component of the WAC. I only introduced the topic. We have about only 7 or 8 minutes. So I will just introduce the next topic and what's coming up next. So what we're going to do next is start talking about cost of debt, and we'll learn method to estimate cost of debt. So you say, Amos, why are you making such a big deal of cost of debt? We know how much interest the company is doing, so take the interest divided by the total debt, and that could be a good estimate. So we will learn that that's not the best one, and we'll talk about 3 methods and which one is more appropriate for different type of companies, okay? So the first one, we'll talk about debt. We'll go over method if we cannot use those ones, and how do we estimate using some parameters. I mentioned here, read chapter 3. It should be a good chapter, not too hard. If you have some stuff that are a little hard, skip them. Don't kill yourself. It's a little, this book is a higher level a little bit for this introductory book, but since it's such a good book, it will be a shame to recommend another book beside this one. I have seen a lot of books, and I think this is really the best book that I know for many years, and I keep updating it. So read chapter 3, it shouldn't be too bad. Chapter 4, a little heavier. There's more equations, that's why I didn't jump and put chapter 4. Chapter 3 should be fine. Please do read it, that will be a good reading. After we finish with the debt, we will move to the equity. And then in the equity, we will focus on the CAPM models that you studied in your finance course. But if you notice in your finance course, you never talked about how do I estimate risk-free? You just accepted it. They gave it to you in the exam. They told you risk-free is 2%, 3%. But how should I estimate it in real life?
Actually, they say that it will be the bonds, the treasury bonds.
Exactly. Is that treasury bonds? Is that should be maybe a long-term bonds? Is that should be a government bonds for 10 years? Should it be, what about if I'm estimating for, I have a business in Greece. Should I use government bonds of the Greece government, or should I use the US? So you will say, well, hold a second. You're doing it in Greece. And in Greece, you should use government bonds in Greece. But then I tell you, you're right, but you are wrong too. Because Greece they are subject to default. So even it's a government bonds of Greece, it still has a risk, and that's my default, and then maybe I shouldn't use that one. And that will be the discussion we will do when we get to this topic. The same things will be about how do I estimate the risk premium. You accept it like given. You were told you do the average over several years on the past. Well, question we're going to raise, how long in the past? Should I do last 10 years average? Should I use 50 years? Should I use it from the beginning that we have estimate on, or when we have the exchange? It started 1926. Should we go up to 1926? What should be the range? Then I will ask, how do I estimate the beta? And even harder, how about if I'm in different countries? And different countries, which should I use? Should I use the US and do the S&P 500 over the risk-free? Let's assume that we already know how to estimate the risk-free. And all those questions will come in the next few sessions. We'll talk about that. How about a company operating in Europe? We already kind of have a feeling that Greece won't be a good one, but should I use the Germany government bonds? If Germany is a risk-free, then we already know that there is no such a thing as risk-free, but we at least try to estimate as close as we can. So one thing we will explore, maybe if we talk about a European countries or a company that's operating in Europe, maybe we should use as a risk-free, Germany risk-free, and that will be as close as possible. And I will give some example in the future, okay? About the risk premium, we'll have to do maybe adjustment. How will we do the adjustment? You know, those questions that theoretically, you never really touch them. In real life, you can't really do without, okay, you know the CAPM, so what the big deal? Implement it. How will you implement it? And that's gonna be the next few sessions. We'll start with risk, cost of debt. We'll move to cost of equity. We'll finish the cost of equity. We do the weighted average cost of capital. And then we halfway done, or more than halfway, almost done. Why? If you go back, yeah. Remember this simple one, we're gonna expand it, okay? We'll use the growth what we learned last week. We will learn the next few sessions about calculating the WACC, and then we'll do a discounted cash flow. We get the net present value. Let me just show you in the simulation. Here I just use Ford. We had the data. In this one, we estimate the cost of debt. That's what we'll do next session. Then we move to cost of equity. We know the cost of equity. This one we did last week. We combine everything together. We come back to here. We'll have the WACC. We have the WACC. We have estimation of growth. So we will get to this point. When we get to this point, then we can say, wow, we really learned a hell of a lot. Then we'll learn some adjustment, and then we'll be done. That will be really, by the way, this is a really good example. So this one, we're getting intrinsic value of a negative. And we'll discuss that in the next few sessions, which will be really nice. Any questions, guys, for the last 2 minutes? Everybody happy? Sasha? Sahar?
Very happy.
Thank you. Have a good one, guys.
Thank you.
See you next
Bye.
week. If you have any
Thank you,
questions,
you too.
feel free to send me emails, questions, and have a nice week.
Thank you. Have a nice week.
Take care.